Have you heard of price to book ratio and looking to learn more? Price to book ratio, or PB ratio, is a valuation metric that compares the stock's current price to the net worth of that company's assets. Hey, welcome to Rynance, the channel centered around your financial education to help make you a better investor. Be sure to subscribe to the channel as I upload new educational stock market videos every week. Price to book ratio is a common valuation ratio that helps investors understand how much they are paying in stock price relative to the net value of the company's assets, also known as book value. Book value is a measure of how much the company would be worth today if they sold off all their assets and paid back all of their liabilities. It's important to note that this only includes tangible assets, which are things that you can physically touch, like cash, real estate, and machinery. Since PB ratio uses the book value of a company's tangible assets, it is most useful for evaluating companies that build their businesses around these hard assets. A technology company, for example, would not be a good candidate for PB ratio since the value of a tech company usually lies in its intangible assets. These can be things like software and trademarks that don't have a physical monetary value attached to them, so keep this in mind when using PB ratio. Let's have a look at how you can calculate the price to book ratio. The formula is the price per share divided by the book value per share. Finding the stock price is easy, but finding book value per share takes a bit more work. First, we need book value, which can be found in the company's balance sheet and can be calculated as assets minus liabilities. From there, book value then needs to be divided by the total shares outstanding in the business to find the book value per share. The output from the calculation will give you a multiple, something like 2 times. A low multiple, like 2 times, is typically regarded as good value, meaning the stock is currently cheap. If you find that a stock has a high PB multiple, like 10 times, this is usually interpreted to mean that the stock is more expensive or that it is not good value for the current price per share. To further your understanding, let's go through an example of how price to book ratio works. Let's say we want to find the PB ratio of this fictional business, Sam's Scooter Company, who has a stock price of $50 per share. Sam's Scooter Company also has a total book value of $150 million, which we found in the balance sheet, and currently has 10 million shares outstanding. The first step is to find the book value per share. So we want to divide the book value by the number of shares outstanding, which would be 150 million divided by 10 million to give us a book value per share of $15. From there, we use the price to book value formula, so we divide the stock price of $50 by the book value per share of $15 to find that Sam's Scooter Company has a price to book ratio of 3.3 times. What this is telling us is that the market is currently pricing Sam's Scooter stock at 3.3 times the net value of the assets in the business. So in the event that the company was liquidated and everything was sold off, the proceeds from the sale would only cover about 1/3 of the market value of the business. We know this because the stock price is currently valued at about 3 times larger than the book value of the business. So why might a company be worth 3.3 times their book value? Well, this ratio implies that shareholders are currently happy to pay a premium of 3.3 times for the stock. This is because investors believe that the company can use those assets to make more money than the assets themselves are worth, thus boosting the total value of the business. There are also certain situations where price to book ratio can reveal red flags of the underlying company. The first situation is where price to book ratio is less than 1. This tells you that the stock is trading at less than the book value of the company, meaning that the net value of the assets are worth more than the total value of their stock. There are 2 ways that you can interpret this. The first being that investors are misjudging the company and the stock is deeply undervalued. In this case, buying the stock for less than book value creates a margin of safety for the investor, because if things go wrong, the company can sell out the business and pay shareholders back in full. The other interpretation is that investors believe the assets of the company are outdated or overpriced in the balance sheet, so they don't want to pay full value for the company. In this situation, an investment may be a bad idea because if the company gets liquidated, the proceeds from the sale won't be enough to pay back the shareholders. Another red flag is when the company has a price to book ratio that is negative. What's happening here is that the company is insolvent, meaning their liabilities are greater than the assets they own. Simply put, the company is hugely in debt and doesn't have enough to pay back its debts since they owe more than they own. You should certainly exercise caution in this situation. because if the company goes bankrupt, they won't have enough money to pay back their debts, and thus shareholders won't get anything for their stock. Finally, PB ratio can be a bit math intensive, so here's where you can find it already calculated for you. My go-to source for financial information is Yahoo Finance, so here we have AT&T stock pulled up on there. To find PB ratio, navigate over to the Statistics tab, and you can find price to book ratio here in the Valuation Measures section. We see that AT&T has a price to book ratio of 1.3 times, meaning the company trades very close to its book value. Thanks for watching today. Do you usually use PB ratio when evaluating a stock? Let me know your process in the comments below. You can check out the playlist on screen now for more educational videos. If you enjoyed the video, give it a thumbs up. And as always, subscribe for more, and I'll see you in the next one.